welcome to the Deep Dive. Today we're tackling a really core topic in finance, the special considerations when you're auditing financial instruments. We got our hands on the International Auditing Practice Note 1000, IAPN 1000, and well, we're going to pull out the key stuff for you.
Yeah, think of this as sort of your express tour through what looks like pretty dense guidance. We want to get to the heart of it, what auditors are really looking at with these things.
Exactly. So whether you're prepping for a meeting or just, curious about how financial audits work behind the scenes, this should give you the essentials.
Right. Auditing standards can seem, well, a bit dry.
Huh.
A bit. Okay. Maybe very dry. But we're looking for those nuggets, the insights into how auditors actually approach financial instruments day to day.
Okay, let's dive in then. Where do we start with IAPN 1000?
Well, first off, it's important to note this IAPN 1000 doesn't exist in a vacuum. It builds on the main international standards on auditing, the ISAs.
Right, the foundational rules for auditors everywhere.
Exactly. So IAPN 1000 gives specific practical guidance for applying those ISAs when you encounter financial instruments. And financial instruments is a really broad term here.
Yeah, it's not just playing stocks and bonds, is it?
Not at all. The guidance makes that clear. We're talking everything from, simple business loans.
Stuff lots of companies have.
Right, all the way up to really complex derivatives. And it's not just banks or big financial players holding these either. All sorts of companies might have them.
Okay, and that variety itself must pose a challenge.
It does. The valuation, the accounting, it can get complicated fast. And the guidance acknowledges that. Some places have huge volumes, sophisticated systems.
While others might just have a few, but they could be really complex ones,
Yeah.
right?
Precisely. So the core aim of IAPN 1000 is practical help. It's not changing the auditor's basic job description or responsibilities, but it's giving context, showing how those fundamental audit principles apply specifically to financial assets and liabilities, like a special lens, you said.
Yeah, like focusing in on one tricky area.
Exactly that. Which naturally leads us to, well, what are these things and what are the big risks auditors worry about?
Okay, so definition time. Broadly, what is a financial instrument?
The guidance defines it as a contract, one that creates a financial asset for one entity.
Like a receivable or an investment?
And a financial liability or equity instrument for another entity.
Like a loan payable or shares issued. Sounds simple enough on the surface.
It sounds simple, but that definition covers a huge range, and that's where the audit difficulties start.
Okay, what are the main headaches?
Well, first, just the sheer variety we mentioned, simple versus complex, high volume versus low volume. Each needs a slightly different audit approach,
Right, and then you mentioned valuation earlier. That sounds like a big one.
Oh, definitely. There's often a lot of judgment involved, especially if an instrument isn't traded actively, like on a public exchange. There might not be a clear market price.
So you have to estimate its value.
Exactly. And that opens the door to subjectivity and potentially what the guidance calls management biases. Management might lean towards a valuation that makes the company look better. Auditors have to be really alert to that.
Okay, so complexity, judgment, potential bias. What specific risks do auditors need to zone in on?
IAPN 1000 flags several key ones. First, there's credit risk.
That's the risk the other side won't pay up, right? Like a borrower defaulting on a loan.
Precisely. Then you've got market risk. That's the value changing because of market movements, interest rates going up or down, currency fluctuations, stock prices changing.
Affects things like bonds and shares directly.
Absolutely. Liquidity risk is another big one.
The risk you can't sell it quickly when you need to, or not without taking a big hit on the price.
You got it. Imagine holding some very specialized, obscure bond and needing cash fast. Finding a buyer at a fair price might be tough.
Okay, I see. That makes sense. What else?
There's operational risk. This covers errors in actually processing transactions or in the valuation itself. Could be a simple data entry mistake.
Or a flaw in a complex computer model used for valuation.
Exactly. And finally, legal risk. This can come from the contracts themselves or, changes in laws or regulations affecting the instrument.
Wow, okay. That's quite a list of potential pitfalls. So how do companies try to manage these risks? What about internal controls?
That's critical. IAPN 1000 really stresses the importance of good internal controls over financial instruments. And naturally, what those controls look like varies a lot.
Depends on the company, right? Big bank versus small manufacturer.
Totally. A big institution with tons of trades needs Very robust, often automated, controls around processing, valuation, segregation of duties, making sure different people handle different steps.
In smaller companies, even if they only have a few instruments.
They still need controls. Maybe simpler, but still important. Things like proper authorization, who gets to make these deals, clear documentation, independent review or monitoring to make sure things are recorded and valued right.
And I guess IT systems play a big role now.
A huge role. Many transactions are processed electronically. So the guidance points out that the IT systems themselves need strong controls. Data integrity, processing accuracy, that's all crucial.
So it's controls over the people and the technology.
Exactly. And the guidance also mentions specific things like, how does the company actually do the valuation? What's their process? Do they reconcile their records with, say, the bank or custodian holding the assets? Are they monitoring things for completeness and accuracy?
Okay, controls are key. Let's circle back to valuation, though, because that seems like a recurring theme of complexity. You mentioned fair value accounting. Why is that so significant here?
Well, fair value is often required for financial instruments. That means reporting them at their current market value, not just their original cost.
Which sounds reasonable, but introduces that estimation problem we talked about.
Precisely, because market values change, and for some things, there isn't an obvious, easily observable market value. So, IAPN 1000 talks about the fair value hierarchy. It's basically a way to rank the quality of the inputs used for valuation. 3 levels.
Okay, what are they?
Level 1 is the best quoted prices in active markets for identical assets. Think of a share price on the New York Stock Exchange. Very reliable, easy to verify.
Okay, straightforward.
Level 2 uses observable inputs, but maybe not direct quotes for the exact instrument. It could be prices for similar assets or values derived from things like interest rate curves. Still observable market data, just indirectly applied.
A bit more work, but still based on market data.
Right. Then you get to level 3. That's where it gets trickiest for auditors.
Why that?
Because level 3 inputs are unobservable. They rely on the company's own assumptions and internal models. This is often necessary for really unique or illiquid instruments where there just isn't good market data.
So management's essentially saying, based on our models and assumptions, we think it's worth this much.
Pretty much. And you can see how judgment and potential bias really come into play there.
Yeah, definitely.
So the auditor has to spend a lot of time scrutinizing those level 3 valuations. Are the models appropriate? Is the data used reasonable? Are the assumptions management made supportable?
What if the company doesn't have the internal expertise for these complex valuations?
Good question. They often use third-party pricing services or hire independent valuation experts. That's common.
Does that let the auditor off the hook? Just accept the expert's number?
No, absolutely not. The auditor still needs to assess the expert. Are they qualified? Are they independent? What method did they use? Does the final number seem reasonable in the circumstances? You can't just blindly rely on it.
Okay, so it adds another layer for the auditor to check. Got it.
So once they're valued, how does this stuff show up in the financial statements? What about presentation and disclosure?
That's another key area. Accounting rules require specific disclosures about financial instruments. It's not enough just to have the number on the balance sheet. Users need context.
To understand the risks and how the numbers were arrived at. Exactly. So disclosures often include quantitative info, how much of each type of asset or liability, but also qualitative info explaining the nature of the instruments and the risks, like the credit, market, and liquidity risks we discussed.
So users get a fuller picture of the company's exposure.
Precisely. And companies also have to disclose their accounting policies, how they account for these instruments, the valuation methods, significant assumptions used. The auditor's job includes checking that all these disclosures are there and that they're clear, accurate, and follow the rules.
All right, this is making sense. We've covered the instruments, risks, controls, valuation, disclosure. Now let's really focus on the auditor's mindset and actions. What are the absolute must-dos for an auditor dealing with financial instruments?
Number 1, underscored throughout IAPN 1000, is professional skepticism.
Maintaining a questioning mind, right?
Yeah.
Not just taking things at face value.
Exactly. Critically evaluating the evidence, being alert for anything that looks odd, considering the potential for misstatement, whether it's error or fraud, especially given the judgment involved.
Makes total sense. What else?
A deep understanding of the entity's business and its processes is vital. How do they actually account for these things? How do they value them? What are their controls really like in practice? Without that understanding, you can't effectively identify the risks.
And if the instruments are super complex or the valuation is highly technical?
The auditor needs to recognize when they need help. The guidance explicitly says they might need to bring in a specialist, like a valuation expert.
But as we said, they still need to supervise and evaluate the specialist's work.
Absolutely. The auditor signs the final audit report. The responsibility stays with them. They need to be comfortable with the specialist's work and conclusions. It's not about doing the valuation necessarily, but rigorously testing management's process and any expert input.
Okay, so understand the business, be skeptical, use specialists if needed. How do they actually gather the audit evidence?
Through substantive procedures. That means detailed testing. For example, looking at specific transactions, confirming balances with third parties, checking the calculations. They also use analytical procedures, looking for unusual trends or relationships in the data that might signal a problem, comparing current year balances to prior years or to industry data, for instance.
Does it matter when they do this testing?
Yes, timing can be important. Sometimes you need to test closer to year end when final valuations are done. Other procedures might happen earlier. It depends on when key data is available or when major transactions occurred.
And dealing with that valuation judgment, how do they challenge management's estimates?
That's a big part of it. They
That-
have to critically evaluate management's assumptions. Are they reasonable, consistent, supported by evidence? Sometimes auditors develop their own independent estimate or at least a range of what seems reasonable.
Like a benchmark to compare against management's number.
Exactly. If management's number falls outside the auditor's reasonable range, that's a red flag that needs investigating.
And they also test the disclosures we talked about.
Definitely. They perform specific procedures to check that the disclosures meet all the requirements of the accounting standards and give a fair picture.
Any final wrap-up points from the guidance for auditors?
Yeah, a couple of things. Getting written representations from management is important, basically. Management formally stating certain things about the financial instruments. And also communication. Auditors need to talk to those in charge, like the board or audit committee, about any significant findings or issues related to financial instruments.
Okay. So pulling this all together, auditing financial instruments is clearly no walk in the park.
Far from it.
It demands, well, a lot. Deep understanding of the instruments, the risks, the controls, plus that constant professional skepticism, especially around valuation and disclosure. Auditor judgment seems absolutely crucial here.
It really is. And what strikes me is how fast this area changes. New types of financial instruments pop up, markets evolve, auditors constantly have to learn and adapt.
Yeah.
Think about that reliance on level 3 inputs management's own assumptions driving the value. That really highlights the need for sharp auditor judgment, doesn't it?
It absolutely does. Or how even a seemingly simple contract can hide various risks. It makes you wonder, doesn't it? With financial instruments getting ever more complex and, frankly, more widespread in the global economy, how does the auditor's role need to change in the future? What sort of new skills or, new approaches might auditors need to really provide that assurance effectively going forward?
That's a great question. Definitely something to mull over. And hopefully for our listeners, this dive has maybe sparked some thoughts or questions relevant to their own work or interests. There's always more to explore.
Indeed. Well, thanks for walking us through that complex landscape, and thanks everyone for joining us on the deep dive. We'll catch you next time.